Okay. Attention, please. Let us start the lecture. Okay, so far we have discussed the most popular valuation models. There are another couple of valuation models that we will discuss later. In the meantime, we will go into the second part of the unit, or let us say of the subject. Remember that this unit is composed of two parts, valuation and financial statement analysis. So we are done, or we finished or discussed most of the valuation models. Now we are going to analyze the financial statements and see how to adjust them for the purpose of forecasting and valuation. I told you in the past that the financial statements reported by accountants cannot be taken as given for the purpose of forecasting and valuation. We need to adjust them and restate them such that there is a clear distinction between operating and financing activities. This distinction is very important because if you still remember that most of the value generated by a firm comes from operating activities. So we need to separate and isolate operating activities from financing activities. Initially, we are going to introduce some important concepts which we later on will use in the reformulation of the statements and also in the forecasting. So let us introduce these important concepts. Remember that cash received from creditors and shareholders usually is temporarily invested in financial assets. Temporarily. This is not the main business of a firm unless the firm is a financial firm. If it is a non-financial firm, then this process is just a temporary process. Remember that financial assets are usually marketable securities or debt securities issued by other firms. A firm, when the firm has surplus cash, instead of keeping the cash in its safes or in the bank accounts without earning interest, usually firms, they invest the surplus cash in financial assets or debt securities in order to earn interest temporarily until they find a new project and invest the surplus cash in these projects, okay? Also, cash payments to shareholders and also creditors are usually made by liquidating financial assets. Net financial assets are debt purchased from issuers or financial assets minus debt issued to debt holders or financial liabilities. In other words, net financial assets is lending minus borrowing. Financial assets are lending. Financial liabilities or obligations are the borrowings of the firm. So if the lending is greater than the borrowing, we say that the firm has net financial assets. Now, if the borrowing is greater than lending, or the difference between financial assets and financial liabilities, if the difference is negative, we say that the firm has NFO, net financial obligations. Okay? If the difference is negative, we say that the firm has NFO, net financial obligations. Again, cash generated from operations is also temporarily invested in net financial assets. Cash investment in operations is made by reducing net financial assets. Sometimes cash investment could be negative, sometimes. This is the case when a firm, for example, liquidates or sell some of its productive and operating assets In this case, the proceeds from selling or liquidating its operating assets is greater than the amount spent to buy operating assets. Okay? For example, it could be a firm might be, for example, in a year, invest 6,000 or 6 million to buy operating assets, but at the same time the firm sold, let us say, 20 million worth of other assets. In this case, the net investment or the cash investment is negative. Negative investment means cash inflow. Be careful, okay? Negative investment means cash inflow. Okay. F is the net cash flow to borrowers and creditors, or debt holders and issuers. It is defined as the net purchase of financial assets. This one is lending minus interest received. Usually the interest received is on the lending, right? Interest received usually is on lending. This is the interest received on our lending activities, right? Minus net issue of financial liabilities. This one is borrowing plus interest paid. In other words, we are calculating the net cash from our lending and borrowing activities. We may end up with a cash inflow or outflow. It depends. This one, when we buy financial assets, we have a cash outflow. This one is a cash inflow, interest received. This one also is a cash inflow. When we borrow, we get cash. This one is a cash outflow. When we pay interest, we pay cash. Okay? So F could be a cash inflow or outflow. It depends. Remember that the net purchase of financial assets, this one is the lending, is equal to the purchase of debt or lending minus principal repayments from issuers or from borrowers, those who borrowed money from us. Okay? So how much we lent minus how much we received as payment of the former lending. Okay? Usually these principal repayments are made on existing debt, old one. When we in the past lend money to others, we may receive principal repayments. So the difference between the lending within a year and the principal repayments gives us the net purchase of financial assets. Okay? Net issue of financial liabilities is equal to debt issued or raised, this is the borrowing, minus how much we paid of the existing debt we in the past borrowed. Okay? This is a new borrowing, and this one is the principal repayments on our old amount borrowed in the past. Make sense? Okay. NFA again is the net financial assets. It is the financial assets minus financial liabilities or financial obligations. Sometimes we say financial obligations instead of liabilities. If the difference is negative, we have NFO, net financial obligations. Okay? D, you know what D is. D is the net payout to shareholders. It is the cash dividend paid to shareholders plus the stock repurchases. This is the amount in dollar terms. This one is in dollar terms. Stock repurchases minus stock sales. This is also in dollar terms, the proceeds from issuing shares. So these two, this and this, together is the amount paid to shareholders. Cash dividend is an amount paid to shareholders. Share repurchases or stock repurchases, we are talking about the amount spent by the firm to buy back some of its shares. This is the meaning, okay? And the stock sales, this is the proceeds from issuing shares. So how much we paid to shareholders minus how much raised from them. Okay, that gives us D. This is the net payout. You remember D. Okay. C is the cash flow from operations. I is the cash investment in operations or operating assets. Remember that operating assets refer to all assets used to run the operations of the firm, such as receivables, inventory, and fixed assets. All the assets used in the operations are operating assets. And operating liabilities refer to all liabilities incurred also during the operations of the firm or to run the operations of the firm, such as accounts payable, wages payable, accrued liabilities. The difference between them, operating assets and operating liabilities, the difference is called net operating assets. Okay. So this diagram shows you the flow and the flows and the uses of funds. F summarizes the transactions between the firm and borrowers and or creditors. D summarizes the transactions between the firm and the shareholders. C and I also, remember that C is cash generated from operations. It is temporarily invested here in net financial assets and later on to retain cash to creditors or shareholders. And the same applies to I. We use the funds received from creditors or shareholders to invest in net operating assets. Remember that F and D are financing activities, C and I are operating activities. Believe it or not, that C minus I is equal to D plus F. C minus I, remember, this one is the free cash flow to the firm. And that is equal to D plus F. Okay? This identity is important because it shows us how the funds are used by the firm. There is a rule which says that if C minus capital I, this is the investment in operations, minus little I is the net interest paid. It is defined here. It is the net interest paid on after-tax basis. If the difference is greater than D, or you can write it like this, C minus big I minus little I minus D, if the difference is greater than 0, we have a surplus cash. This surplus cash is used to lend or buy additional financial assets or to reduce existing debt. Remember that little I is a component of F. Remember that F is what? Is the lending minus interest received minus borrowing plus interest paid. This is outflow, this is inflow, this is inflow, this is outflow. So this one, and this one, interest paid and interest received, interest paid and interest received, the net is little I. So little I refers to the net interest paid. Okay? So if the difference between C and I and little I and D is greater than 0, because of this identity, then the surplus cash should be spent on either lending or to reduce the borrowing. Okay? Because we have here an identity. Any surplus cash should be used to lend money or to buy additional financial assets or to reduce existing debt. Make sense? Okay. And if the difference is negative, or the difference between C and I and little I is less than D, alternatively, we can write this one like this. If the difference is less than 0, we have a deficit, and this deficit is to be covered either by increasing our borrowing or reducing our financial assets by selling some of the existing financial assets. This is how the deficit is covered. We either borrow money or we liquidate our financial assets if we have some. Make sense? Okay. This is an example. In its second quarter for 2004, Microsoft generated $4,064 million in free cash flow and received $338 million in interest net of tax from short-term marketable securities it held. It paid a net $2,270 million in cash out to shareholders, leaving $2,132 million with which it purchased short-term interest-bearing securities. Okay. This is in 2004, so this is the amount of C, this is I, the difference, this is the free cash flow, C minus I. As we can see, the firm in this year had net interest received. Instead of subtracting, we add to this one because it is a cash inflow. So this is the sum, this is the sum, this is the cash available to shareholders. The firm paid out these amounts to shareholders, but raised this amount from them. So the sum here gives us the net payout. This is the net payout. So the firm had this cash available, and this is the net payout to shareholders. This minus this gives us the surplus cash, which is used to purchase additional financial assets. Because the difference is positive, we have a cash surplus. So the surplus is used to buy additional financial assets. Make sense? Okay. In the second quarter of 2005, again, we have positive cash available to shareholders. The firm paid out, this, look at the amounts paid out to shareholders. This is a huge amount. This is dividend, this is share purchase, and this is the proceeds from issuing shares. So this is the net payout to shareholders, and this is the cash available to shareholders. This minus this, as we can see, we have a negative amount. This negative amount was financed by selling financial assets. Between parentheses means that if this one is negative, is to be financed by selling financial assets. Okay? This is another example for General Electric. This is C, this is I, the difference was negative. C minus I, as we can see, the firm had negative free cash flow in that year. On top of the negative free cash flow, the firm also had net interest paid. So this net interest paid is to be added as a negative figure to the negative figure here. So this is the cash available to shareholders, which is negative. So it becomes this minus this, we get this number. Okay? So negative cash available to shareholders. On top of that, the firm, this plus this, the firm made the following net payout. So the sum, or this minus this, gives you this. So this one is a deficit. and this amount is to be covered somehow. The question or the information given to us says that on top of this amount of deficit, the firm in that year also was required to pay off this amount of due debt. So 57.8 billion. This amount is a debt due to be paid in that year. So the treasurer in that year issued the sum of these two amounts. So this is the amount raised by the treasurer. It is the sum of this amount and this amount. So this amount was raised to cover the deficit as well as to pay off the debt due in that year. Make sense? Make sense? Any problems? Any questions? Okay. So, now after we have discussed the relation between C and I and D and F, when you use the statement of cash flow for forecasting and valuation, we restructure the statement according to the identity discussed before. Operating items are together and financing items together. We restructure the statement such that C minus I is equal to D plus F. So any transactions between the firm and shareholders should be summarized within D, and any financing or borrowing and lending activities should be summarized within F. So D plus F must equal C minus I. Okay? So using this structure of the statement of cash flow, we can restructure the statement of cash flow for both Microsoft and General Electric. As we can see, this is a restructuring of the statements using the former examples. So for Microsoft in 2004, this is C, this is I, this is C minus I, and this is D, the net payout to shareholders, and this is the net purchase of financial assets, and this is the interest on financial assets after tax. As we can see, the sum of D, this is D, and these together is F. The sum of this plus this minus this gives you this, and this one, as you can see, is equal to C minus I. Okay? The same applies here for the second year, and for General Electric, again, as you can see, okay. So now we have an idea on how the statement of cash flow should be restructured when we use it for the purpose of forecasting and valuation. Restructuring the statement in this way will make it very easy for us to focus on the items we want to forecast. If we want to use the free cash flow in the valuation, we have the free cash flow properly classified after cleaning C and I from financing items. We move them to the other side or to the bottom side. Okay? So we clean the C and I, and we can safely use them in the forecasting. Okay? The same applies to the balance sheet. When we use the balance sheet to make pro forma statements or to use them for forecasting and valuation, we need to restate or reformulate the statement. Remember the structure of the balance sheet. Usually, we have assets on one side and liabilities and equities on another side. Assets are usually classified as either operating assets or financial assets. Remember that operating assets refer to all assets used in the operations of the firm. Financial assets refer to our lending, when we lend money to other firms. Okay? The same applies to liabilities. Liabilities can be classified under two categories. Operating liabilities. These liabilities are or refer to those that are incurred to run the firm or the operations of the firm, such as accounts payable, wages payable, accrued expenses, so on and so forth. Alternatively, or the second category is the financial liabilities or financial obligations. This is borrowing. We are talking about the borrowing. All other liabilities, all liabilities other than the borrowings are to be classified as operating liabilities in general. There are some exceptions. We will discuss them later on. Later on, I will show you, we will discuss the definition of each one by one and see how to properly classify them. But in general, we know what lending is. Okay? In general, all other assets are to be classified as operating assets, with some minor exceptions. We will talk about them later. The same applies here. All other liabilities other than borrowing should be classified as operating liabilities. Okay? That is very easy to understand, right? Okay. CSE here is a shortcut for common shareholders' equity. So remember, CSE, we are talking about common shareholders' equity. If we have a preferred equity, it is to be classified as a financial liability. Preferred equity is to be treated as a financial liability or obligations. Make sense? Because again, from the perspective of common shareholders, these guys are to be satisfied before anything is paid to them. Yes, please.
With the financial assets, can we account for a change in the value due to a change in the cash rate of the bond increase or decrease in value?
Change in the value, cash rate?
Changing the value of the bond.
Of a bond because of a, you are talking about unrealized gain or losses. These are, it depends on whether you are talking about securities held for trading or available for sale. Okay? If they are available for sale, then the gains and losses are usually reported under other comprehensive income, under the equity section. If they are for trading, then the gains and losses are to be classified under in the income statement. Okay? Yeah. And they are usually reported in the balance sheet, usually reported on fair value or the market value. So the reported figures are usually the market value, except those that are held until maturity. These are at historical cost. Okay? Okay? But all of them are to be treated as financial assets. Okay? All of them are financial assets. But remember, some of them are reported at fair value, available for sale and trading. These are usually reported at fair value. And those that are held until maturity, they are usually reported at historical cost. Okay? Again, all of these debt securities held by the firm, all of them are financial assets. For the purpose of restatement, for the purpose of reformulation of the statements, all of them are to be treated as financial assets. Any lending item is, or financial assets item in general, is to be treated as a financial asset. Anything like related to lending, a financial assets. Okay? Okay. So when we restate the balance sheet, we restate it again. Remember, the key idea here is to group operating items together and financial items together, separate them from each other. So this is what we do here. We move the operating liabilities from the liabilities side and we combine it with the operating assets and we take the net. So we have net operating assets. Operating assets minus operating liabilities. Okay? At the same time, we move financial assets from the assets side to the liabilities side and combine it with the financial liabilities. Remember that FO is financial obligations or liabilities. So we take the difference between the two and we have NFO. At the end of the day, the balance sheet should be restated such that net operating assets must equal NFO plus CSE. So the two sides must be equal. Otherwise, we no longer have a balance sheet in balance. It will not be balance sheet. Okay? The two sides must be equal. If there is a minority interest or minority equity, if you still remember the definition of minority interest, it is the equity stake of others in our subsidiaries. It is to be added here, plus minority interest. Okay? We keep it on this side and treat it as a plug item. It is not an equity that belongs to our common shareholders, and it is not also a financial liability. Okay? It is an additional item to be added to the equation. Okay? Okay. Now we are introducing just the structure. Next week, we will explore the balance sheet in greater details and see how to do that, or next lecture. And the same applies to the income statement. This week and next week will be the most, next lecture will be the most difficult lectures. After that, it will be, the lectures will be easier than these two. Okay? But let me tell you something. You will get familiar with these things. You will get familiar. These things, because they are new to you, you find them difficult to digest. But with the passage of time, they will become very common things for you. Once we read the material, once we solve the workshops, you will become familiar with them. We need also to make the necessary restatement or reformulation even to the income statement. Remember that operating income is equal to operating revenues minus operating expense. So OI refers to operating income, OR operating revenues, OE is the operating expense. Remember also that we have also net financial expense. We have financial expense. The most popular item under the financial expense, the most popular item or the major one is usually interest expense. We have also financial income. The most popular item is usually the interest income. Maybe we have other kinds of financial expense. That's why we use a broad name here to refer to other financial expenses. But the most popular one is usually interest expense. And here, maybe we have financial income other than interest income. So we use a broad name here, but this is the most popular item or the main one, usually. Okay? The difference between them, FE minus FI, is the net financial expense. The difference is the net financial expense. Once we have calculated net financial expense, we take it out from the operating income to calculate the comprehensive income. So CI is the comprehensive income. It is operating income minus net financial expense. Okay? Note that these items are usually calculated on after-tax basis. We will discuss them later on. Note also that we are talking here about the comprehensive income, which means that any gains and losses that are usually reported in the equity section of the balance sheet should be exported or reported here when we calculate the comprehensive income. Okay? Oh, sorry. Mute. Okay? So any gains or losses reported under the equity section should be reported here when we do the restatement. Okay. Now, once we have done the reformulation, it is very important to understand the interrelationships between the items in the financial statements. Remember that operating revenue minus operating expenses is equal to operating income, and operating income minus the change in net operating assets is equal to C minus I. So this is another formula for C minus I. And C minus I minus the change in the net financial assets plus the net financial income equal to D. Remember that these two together equals F. So this is just C minus I minus F equals D. Remember that C minus I is equal to F plus D. So C minus I minus F equals to D. Okay? Remember these relations and equations because they are very useful in the coming lectures, as well as they are very useful for the purpose of forecasting. We will work on these equations and see how they are related. So we said that there is another equation for the free cash flow. The free cash flow can be calculated as the difference between operating income and the change in net operating assets. This is another equation for the free cash flow. Remember also that the free cash flow is also equal to F. These two together is F plus D. Remember that F summarizes the cash flow from lending and borrowing activities. This formula applies when the firm has net financial assets. If we rearrange this formula for D, D equal to C minus I minus the change in NFA plus NFI, as we can see, we can say that dividends are paid out of a free cash flow, and the interest received or earned on financial assets, and also by selling because we have here a negative sign. The net financial assets. So these are the sources of funds that are usually used to pay out dividends. Okay? Make sense? Okay. The second version of this equation, C minus I equals to F plus D, is this one. C minus I, again, this one, these two together is also F. It applies when the firm has net financial obligations rather than net financial assets, okay? If we arrange the formula for D, here, this one, rearrange it for D, then D is equal to C minus I minus the net financial expense plus the change in net financial obligations, which means that dividends is the cash left over from the free cash flow after paying net financial expense, and might be also paid by increasing because this one is positive, the net financial obligations, in other words, by borrowing, increasing borrowing. So these are the sources of funds that are used to pay out dividends, or this is how dividends are paid. So as we can see, if you still remember, lecture 3, we said that dividends is not a good measure of value because it is a distribution of value or usually paid out of earnings. But at the same time, sometimes dividends are paid out of sources other than earnings, such as, for example, by increasing borrowing. Okay? So it is not a good measure of the value generated by the firm. Okay? So, remember that C minus I can be written as operating income minus the change in net operating assets. The change in net operating assets is the net operating assets at time t minus net operating assets at time t minus 1. So if you rearrange this formula for the net operating assets at time t, net operating assets at time t is equal to net operating assets at time t minus 1, the lagged one, plus the operating income at time t minus the free cash flow at time t. So this equation is very useful because we can use it later on to forecast the future net operating assets. For example, next year, net operating assets is equal to the current year net operating assets plus the expected operating income for next year plus minus the expected free cash flow for next year, for example. Okay? So these equations are very useful for the purpose of forecasting. We will use them later on when we forecast the balance sheet of the firm. Okay? We can use also the former equation, this one. We can use this equation, this one, and rearrange the formula for the NFO at time t is equal to NFO at time t minus 1 plus the net financial expense minus the free cash flow plus dividend at time t. This equation applies when the firm has net financial obligations. If the firm has net financial assets, this is the second version of this equation. The net financial assets at time t is equal to the lagged balance of net financial assets plus the net financial income plus the free cash flow at time t minus dividend at time t. Okay? Don't worry about memorizing the equations because we will give you a formula sheet during the exam with all of these equations. So you do not have to memorize them, try to understand them, okay? Understand rather than memorize, okay? Okay, so let us summarize what we have said so far. So remember, net operating assets at time t is equal to the lagged one plus operating income minus free cash flow. And the net financial obligations at time t is equal to the lagged one plus the net financial expense minus the free cash flow plus the amount of dividend. And the common shareholders' equity at time t is equal to the lagged one, this one put here plus, okay, put here plus CI minus D. If you still remember, you remember when we used to say the book value at time t is equal to the lagged book value at time t minus 1 plus earnings minus dividend? You remember this equation? This is the same. Equity at time t is equal to the lagged 1 plus income or comprehensive income minus dividend or net payout. This is the same equation. We are talking about the same thing. Okay? Remember that this figure, CI, comes from the income statement. Income statement is the operating income minus net financial expense, gives us the comprehensive income. And the amount of D is borrowed from the statement of cash flow after we have reformulated the statement, okay? So it is borrowed from here. Note that the last line also, the last line can be arrived at by subtracting the second line from the first. So if you subtract this line from the first one, you get the last line. For example, this minus this gives you this. Operating income minus net financial expense gives you this. This quantity minus this quantity gives you D, because we can cross this one against this one. And this minus this gives you this. Okay? So now we can see the interrelations between the statements, okay? Okay. So, remember that we said that we need to restructure the statement such that net operating assets, the balance sheet need to be restated such that net operating assets is equal to NFO plus CSE. It follows that CSE is equal to net operating assets minus net financial obligations. Think about it as follows. Assets minus liability, this is what we are talking. But here we are talking about net assets minus net liabilities. That will give you the common shareholders' equity, right? Okay. If you plug the formula for the net operating assets, remember that the net operating assets is the lagged one at time t is equal to the lagged one plus operating income at time t minus free cash flow at time t. And if you plug the formula for the NFO, this is the formula for the NFO, and then try to simplify the equation, net, we can cross this one against this one, and you can this one against this one, and we end up with the following. Okay, net operating assets at time t minus 1 minus net financial obligations at time t minus 1. These two, this minus this, gives you lagged common shareholders' equity, right? Right? Yeah. And operating income at time t minus net financial expense at time t gives you what? Earnings at time t, or comprehensive earnings if you wish. You can write it like this, comprehensive income at time t. Okay? And finally we have D. So as we can see, this is how common shareholders' equity evolves with the passage of time. So common shareholders' equity at time t is equal to the lagged one plus earnings, or comprehensive earnings if you wish, minus dividends. Okay? Where the value comes from? From earnings, right? So this is the major source of value, or the addition to the equity, right? Right? Okay. For this to be true, accounting must be clean surplus. In other words, clean surplus means any gains and losses reported in the equity section should be also reported in the income statement. Okay. 5-minute break. A very tough lecture, I know, huh? Difficult? Difficult? Okay, when you go home, just read the lecture notes again and listen to the recording. Lectures are recorded, which is good for you. Listen to the recording and read the slides. You'll find it easy, trust me. If you still have troubles, come to me. I'm happy to help you, okay? Come to my office. I will tell you something. If you take a unit and you find the material easy and familiar to you, it means that there is no value added. But if you find the topics new to you, this is good. There is a value added, positive value added. Okay? So how do you find this unit? Positive value added? Okay. Don't worry. I'll tell you something. I know that the volume of the topics we cover in this unit is big. But it is very useful for you. You will find it very useful, really. And we have to do that because this unit cannot be split into two parts, valuation and financial statement analysis. They are interrelated, so we should cover them together. However, because I am aware that the volume is big, in the final exam, normally I give tips, very useful tips. I will tell you the slide numbers from where the questions are coming. Okay? For the final exam, I will tell you where the slide numbers and where the questions are coming from. So that will make it easier for you and save you a lot of time, okay? Don't worry. You will be fine. Last year, and been teaching this unit for 3 or 4 years, and every year students are doing very fine. Last year, the average after the final was 73, which is good. This is at the higher end of our distribution, which is good. You will be fine, don't worry. Okay, let us continue. So now we are aware of what we are supposed to do with the financial statements. Again, we cannot take the financial statements as given. We have to restate them. Remember that when we use earnings or cash flows for valuation, we need to use the clean surplus accounting. We also need to use the comprehensive income in the forecasting and valuation. Remember that comprehensive income is composed of two items, the net income in the income statement and gains and losses that are usually reported under the equity section. Let us see how this equity statement or the statement of shareholders' equity is usually reported and do the cleaning process inside this statement. The whole idea here is to clean the equity statement. Remember that there are four statements: balance sheet, income statement, statement of cash flow, and statement of shareholders' equity. Remember what I told you in lecture 1. I told you everything we do here is for the purpose of valuing common equity. Okay? Because of this, and because in practice accountants usually they report things without cleaning or not useful, very useful for the purpose of valuation, it is our duty as analysts to clean the statements and make them ready for forecasting and valuation. For example, the statement of shareholders' equity, usually accountants they combine common equity with preferred equity with minority equity all together under the equity section. This is not good for us. We need to remove everything that is not related to the common equity. Okay? So this is the way the statement of equity is usually reported. Normally in the opening balance, common equity is combined with the preferred equity and the minority equity. Then we have transactions with the common equity. We have transactions with the preferred equity. We have also the change, the retained earnings and the change in retained earnings, blah, blah, blah. And finally, we have the closing balance of equity. We do not need all of this. We need only that part that belongs to the common equity. So this is how we clean the statement and confine everything to common equity. Note, this is the restated common equity. We restate it as follows. We start with the opening balance of common equity only, and also the closing balance should be for the common equity only. Okay? So if there is any preferred equity in the opening balance or the closing balance, it should be removed. The same applies to the minority equity. This is the equity stake of others in our subsidiaries. Okay? Within the opening and the closing balance, we need also to summarize the transactions with common shareholders as follows. For example, here, this is the proceeds from issuing shares minus the share repurchases minus common cash dividends. This minus this minus this gives us what? Gives us the net amount raised from common shareholders. Okay? If you have a look at these transactions, it is just negative D. This is negative D. In the past, D is the net payout to shareholders. Here, when you multiply it by a negative sign, you get net amount raised from shareholders. So the signs here are reversed. Right? The signs of these transactions are reversed when we calculate net transactions with common shareholders. After we have summarized the net transactions with common shareholders, we need also to calculate the comprehensive income to common shareholders. To common shareholders. So we start with net income. If there is an income that belongs to the minority or non-controlling equity, it should be subtracted from the net income. Remember that subsidiaries, if we own, for example, less than 100% of the shares of subsidiaries, but more than 50 but less than 100, the remaining equity belongs to others. Okay? They are also entitled to the income of our subsidiaries proportional to their equity stake. So if their equity stake is 30%, then they are entitled to 30% of the income of our subsidiary, right? So this income that belongs to others in our subsidiaries should be subtracted from the net income. This is the net income in the consolidated income statement, okay? And all other gains and losses that are usually reported under the equity section should be combined together on after-tax basis under other comprehensive income. So other comprehensive income should include all other gains and losses that are usually reported outside the income statement. Make sense? Okay. And also if there is preferred dividends, we should subtract it. So this minus this plus this minus this gives us the comprehensive income to common shareholders. That part of the income that belongs to the common shareholders. Make sense? Okay. So now the statement is clean. When we do that, the statement is clean. On top of these items, there is something else. If under the liabilities, okay, so these are the steps. Let me explain this additional point further. So these are the steps we follow. First, we need to restate the beginning and ending balance for items incorrectly included in or excluded from common equity. So we remove preferred equity if reported under the equity. We remove the minority interest or minority equity. And if there is dividends payable to common shareholders, if it is reported under liabilities, we should include it. Okay? We include it in the statement of equity or the equity section. Okay? If there is any dividends payable to common shareholders, it should be included. If there is a dividend payable at the start of the year, we include it in the beginning balance of equity. And if there is dividend payable at the end of the year, we include it in the closing balance of equity. Make sense? Okay. Remember that net transactions with common shareholders is just negative D. Okay? And it is equal to share issues minus cash dividend minus share purchases. Under the equity section, you will find dividends to common shareholders. However, these dividends need not be cash dividend. So cash dividend is calculated as follows. Cash dividend is equal to the dividends reported under the equity section minus the change in dividends payable. Okay? Okay. Now let us see a numerical example. This is the equity statement of Nike. Okay, I will assure you, in the exam, I will not ask you something complicated like this, okay? Just relax. But you have to get an idea about these things. You must learn these things, okay? So relax, don't be afraid. It doesn't mean that you shouldn't read these things. You should. You have to. For your own knowledge, you will find it very useful. I'll tell you a story happened with me a couple of years ago. There was a student in the past. This unit was lectured in a very simplified way, and the focus was only on the valuation models. So I met a student a couple of years ago, and he told me that he got an internship with a firm in Sydney. And he told me, Mahmoud, there, they need someone. The valuation models are already built into their softwares. They have softwares that can, with all the valuation models. The most important for them was not how to use the valuation models. The most important for these firms is how to feed into these valuation models by restating the statements and building forecasts. That's why I decided to include these things, okay? For the benefit of our students. You must learn these things because this is what employers in practice are looking for. So if we teach you only the valuation models, that is not enough. Remember, we used to get the expected earning per share and expected dividends and use them and calculate the residual earnings or the free cash flow and apply them to the valuation models. Okay, that is not enough. But how we expect the earnings? How do we forecast dividends? How do we forecast? This is the most important thing. Okay, so we need to learn these things. Okay, so this is the reported statement, and we need to do the necessary reformulation. This is the beginning balance, and these are transactions with shareholders. This one is an expense item related. This one related to this one. I will explain this point further. The firm in this year issued shares after some options were exercised. Okay? So you know option incentives. Firms in practice sometimes they award their employees options. The option, or usually these options are call options. Call options, they give the holder the right to buy the stock at a predetermined price. Now the problem is that if the market price is greater than the exercise price, when the employee exercises the option, the difference between the market price and the exercise price is a loss to the existing shareholders. Okay? Okay. Accounting for this loss is usually based on grant date accounting. On the grant date, when the options are awarded, usually firms, they calculate the value of these options and then they amortize the value over the service life of the employee or the vesting period. However, this treatment is not enough. We need to do something else called exercise accounting. I will explain this point further. In the meantime, let us deal with the easy parts and then we talk about this one in greater details. So this is how we restate the statement. The balance, this is the beginning balance. We take the reported beginning balance, 8693, this one, and we add the dividend payable at the beginning of the year. This is the adjusted beginning balance. We go to the end of year also balance. This is the end of year reported balance. And because there was a dividend payable reported there, we add it. So this is the ending balance after the adjustment. Okay. We calculate also cash dividend. This is the reported cash dividend. We take it from here. This is the reported cash dividend. This is the reported dividend or declared minus the change in dividends payable. This is the end of year dividends payable. This is the beginning of year dividends payable. We take the difference between the dividends declared or reported and the change in dividends payable. That gives us the cash dividend. We use it here. Okay. All other items are taken as given. So this one, 379.6, is taken from here. This one, 37.1, is just the sum of these two, 40 minus. This one is 40 minus 2.9. Now 40 and 2.9, as you can see, this is the issuance of shares to employees, and this is the forfeiture of shares from employees. Okay? Issuance of shares, we know what the meaning of issuance of shares is, huh? But the forfeiture, this is the case when one of the employees or some employees, they lose their right to the shares because, for example, they didn't meet the conditions. For example, a firm may give you some shares as incentives under certain conditions that you have to serve the company over the next 3 years. After 3 years, these shares, you can sell them as you wish. If you resign before 3 years, for example, you lose your right to the shares. So this is the meaning of forfeiture of shares. Okay? Okay. So the net amount, this and this, is reported here, 37.1. Stock repurchased is taken as is. It is here, this one. And this one is calculated here. We use this figure and the change in dividends payable. Now we have one item, this one, 159, stock-based compensation. This is an expense item. Because it is an expense item, it is reported here. Why is that? We need to isolate transactions with shareholders from gains and losses. Gains and losses should be reported, gains and losses and expenses in general should be reported under the comprehensive income. That's why we remove it from the upper part. We take it from here, this part, and we report it here. Okay? So the upper part, this one, summarizes the transactions with shareholders, issuance of shares, repurchase of shares, dividends paid to shareholders, okay? And the lower part summarizes the income and gains, losses, expenses, okay? So we have a clean statement. Make sense? Okay. This one, net income reported, we take it as given from here. 159.2, we take it also as given from here. It is the foreign currency transaction and other. Okay, so we take it as given. This one, 6.5, is just the sum of these four items because all of them are related to hedges. Okay? This is a hedge. We have hedge here, hedge. So the sum of these four is equal to 6.5. So this one is 87.1 plus 44.8 minus 121.6 minus 3.8. Okay? Okay? So altogether, these ones are 6.5. Okay, now the statement is almost clean. We still need to deal with these two items because they are related. So let us discuss them in greater details. Remember the dirty surplus accounting. Dirty surplus accounting refers to reporting some gains and losses under the equity section rather than under the income statement. These are the most popular items. These are the most popular items. Unrealized gains and losses on available for sale securities. We are familiar with this one. We know what this one is. Huh? We have also currency translation gains and losses. This translation gain or loss arises when the firm has overseas subsidiaries using another currency different from our currency. So, for example, if we have a subsidiary in Japan, this Japanese subsidiary is using the Japanese yen. The problem, there is a problem that usually arises when the subsidiary overseas, at the end of the year, when the subsidiary prepares its financial statements and the balance sheet, some of the items should be reported according to the current exchange rate, and some items should be reported according to the historical exchange rate. Now, when we translate these accounts into our home currency, we may find a difference between the asset side and the liabilities side. This difference creates something called currency translation. We will discuss this topic in the last lecture, okay? This currency translation could be positive or negative. We report it also under the equity section, okay? The currency translation could be positive or negative. In all cases, it should be reported under the equity section. There is also gains and losses on derivative instruments. Derivative instruments are usually used by firms to hedge against uncertainty or against a certain risk. Are you aware of the types of financial derivatives like futures contracts, forward contracts? You know these things? Okay, beautiful. So any gain or loss from these hedging instruments are usually reported also under the equity section. Not something that if you are hedging an anticipated cash flow, in this case it should be reported under the equity section. But if you are hedging an existing asset or liability or cash flow, it should be reported under the income statement. Okay? So it depends on whether we are hedging an existing things or anticipated. Okay. Now, this is the dirty surplus items. These are the most popular items. There is something else called hidden dirty surplus. Hidden dirty surplus, where it is not visible, the gain or loss is not visible, and it is not directly reported anywhere. The most popular one is the one that arises from call options. Remember that call options, they give the holder the right to buy a stock at predetermined price we call it the strike price or exercise price. If the strike price is less than the market value, shareholders lose money. The loss is equal to the market price of the shares exercised minus the exercise price. Okay? This is the loss. Okay? Now, if the loss arises because of options given to employees as part of their compensation packages, in this case, the loss should be treated as an operating expense. And if the loss arises because of a conversion of some convertible securities like convertible bonds or preferred stocks, in this case, it should be treated as a financial loss or expense. Make sense? Okay, beautiful. Firms, sometimes they grant their staff in the money options. In the money options means the stock price is greater than the strike. The stock price is greater than the strike price. Accounting for this case is very easy. Just take the difference, this is the loss, and capitalize it or treat it as a deferred asset, deferred expense, and amortize it over the service life of the employee or the vesting period. The vesting period is the period within which the employee cannot exercise. After the end of the vesting period, the employee can exercise. Okay? This accounting is fine. This treatment is fine. However, the biggest problem is when the firm grants options that are at the money, as the price is equal to the strike price. The stock price is equal to the strike price. The difference here is zero. The difference here is 0. So how to account for these options? The difference is 0. So accounting bodies around the world, they normally require the firm to calculate the value of these options using one of the valuation models. Are you familiar with the Black-Scholes models of options? Black-Scholes model? It is called the Black-Scholes model. It is used to value options using the current price and the strike price and also the probability of the option being exercised. I'm not going to ask you something complicated like this. This is just for your info, but you have to be aware of these things. So accounting bodies, sorry, they require the firm to calculate the value of these options when the options are at the money, and then amortize the value of these options because they are an expense to the firm. Okay? Amortize them over the vesting period or service period. And also there is a liability or contingent liability. So we have a deferred expense and we have on the other side a liability. This liability is marked to market and extinguished against equity when shares are issued on the exercise date. However, there is a problem with this method, the grant date accounting method, is that the expense is recognized over the vesting period, although the option may lapse without being exercised. Remember that the option gives the holder the right to exercise. There is no obligation on the holder. Okay? No one can force you to exercise. So if the stock price is less than the strike on the exercise date, you will not exercise, right? But still the firm is recognizing the expense over the vesting period, although the option may lapse without being exercised. So this is not a fair treatment. The alternative is to use the exercise date accounting, when the options are really exercised, and then we reconcile the loss arising from the exercise, we reconcile it against the expense calculated according to the grant date accounting. If it is less, we add back the difference. If it is greater, we subtract the difference. Make sense? I will show you how to do it now. For our firm, Nike, there is a hidden loss from exercising the option. The hidden loss is telling, the author here is telling you that if you go to the statement of cash flow for Nike, if you go to the statement of cash flow, it was, we already saw the statement of cash flow for Nike in lecture 1. If you go to lecture 1, there is the balance sheet, statement of cash flow, the income statement for Nike. There was an item under the financing section called tax benefit from exercising options. This tax benefit was 58.5. Since it was a tax benefit, it means that there was a tax saving. This is the meaning. Tax benefit means tax saving. This tax saving arises because of the loss when the options were exercised. How to estimate the loss? Simple. Just divide the benefit by the tax rate. So this is the benefit divided by the tax rate. Okay? And that will give you the amount of the actual loss because of the exercise. Okay? If you still remember, tax saving on any tax deductible expense is equal to the expense times the tax rate. So any tax deductible expense, the saving or the benefit from this expense is equal to the expense times the tax rate. So if you are given the tax saving and the tax rate, then you can easily calculate the expense. The expense is equal to the benefit divided by the tax rate. This is what we did here. Make sense? Okay? So here, the benefit is equal to the expense. The expense is equal to the tax benefit divided by the tax rate. This is the benefit. It is reported in the statement of cash flow. Go to lecture 1 notes and you'll find it there. Okay? This is the tax benefit. We divide it by the tax rate. We estimate the pre-tax expense. So this is the pre-tax expense. This is the tax saving on the expense, and this is the after-tax expense. Make sense? Okay. Now, once we have calculated the pre-tax expense, the after-tax expense, sorry, this is the actual expense or loss when the options were exercised. This is the actual one. Okay? We add the after-tax loss to the reported stock issued from stock options, because this one was reported initially after taking or net of the loss incurred from the exercise. Why we do that? So this figure is equal to 379.6 plus 102 point. This is the after-tax expense. 1.26. Okay? There is another way to calculate it. I don't want to confuse you. Just look at this one, you'll be fine. Okay? This is the reported figure. It was reported net of the loss. Net of the loss. This figure. Initially, stock options exercised. This is the value of shares issued when the options were exercised, net of the loss on after-tax basis. So we add back the loss. This is the loss on after-tax basis in order to calculate the value of shares issued as if there was no loss. Any loss incurred from the exercise should be reported here under the comprehensive income. The idea here is to make the sheet clean, the statement clean. Okay? Losses and gains should be reported here under the comprehensive income. If there is any amount here reported net of loss, we should add back the loss. Make sense? Make sense? Again. Yes, please.
So with that value of shares, is that the after-tax value of that expense?
Yes, yes. Yeah. This figure is reported after the loss, on after-tax basis, when the loss is calculated after tax losses. Okay? So that's why we add back the loss. So this figure gives you the value of shares issued at market price. If there is any loss, it should be recognized here, not here, here. If there is any loss, it should be reported here rather than here. Yes?
So just that 482.2 is the current market price of
The value, yeah, the market value, exactly. The current market price of the shares issued when the options were exercised. There was a loss, it should be recognized here, not here. To have a clean statement. There was a loss when these shares were issued, but this loss is to be recognized here. Here we report the issuance at market price.
So that's when they were issued or when they were exercised?
Exercise. The shares are issued when the options were exercised. We have two things here, options and shares. When the options are exercised, there were shares issued. When you exercise an option, the firm should issue shares for you and give you shares because you exercise the option to buy the share. Okay? So we are talking about issuance of shares, stock issues for stock options exercised. Here we are talking about options exercised. Okay? So this is the value, the market value of the shares that were issued when the options were exercised. Okay? Okay. There was a loss. We shouldn't report the loss here. We report this figure on market value or market price, and the loss on the when the options were exercised should be reported here. So this is the after-tax loss when the options were exercised. Now this figure should be reconciled against what? Against the expense. This is the expense using the grand data counting. We take the net figure, this and this, we take the net, this is the net, and it should be added to this. We add it back to the comprehensive income. Okay? Make sense? So this figure is the sum of this and this and this and this. So we take the net. This is the loss based on the exercise data counting, and this is the expense based on the grand data counting. We take the net and add it back here if this one is greater than this, or we subtract it if this one is greater than this. It depends. Okay? Don't worry, I will not ask you something like this in the exam. Trust me. Okay. So maybe this is the most difficult point in the whole lecture, okay? Usually students, they struggle with this part. Read the lecture notes, listen to the recorded lecture. If you still have troubles, come to my office. I'm there to help you, okay? We'll be fine. Okay, now let us see how the loss arises and the contingent liability, because when there is a loss, remember, we create a deferred expense item and a liability item. The liability is usually a contingent claim. Okay? Okay. The option overhang is the value of options not yet exercised. This contingent liability is the estimate of the amount of value that shareholders will give up on the exercise date. So we calculate the loss on after-tax basis as follows. We take the market value of shares minus the exercise price, the difference, and then we take into account the tax benefit, and the after-tax loss is the contingent liability. Here we do not pay attention to the value of options. We just take the difference between the market price and the exercise price. Let us see a numerical example. At the end of 2010, Nike had 36 million employee stock options outstanding at a weighted average exercise price of 46.6. Imagine 36. Why we are discussing these things? Because these options have dilutive effect on the earning per share. So when you value a firm or the equity stake of shareholders, you should take into consideration other convertible or option on these shares. Because if the option holders decided to exercise or holders of convertible securities decided to convert, then new shares are needed to be issued. And that will increase the number of shares outstanding and reduce the earning per share. Make sense? So you need to take into account these things because they have an effect on the earning per share. So the stock at that time was trading at 72. Imagine, employees at that time, they could have exercised the options and buy the stock at 46.6, but the market price of the stock was 72. Imagine. So this is the market value of the shares if the options were exercised. 36 million options, and each option gives the holder the right to buy a share. So this is the number of shares or options, times the price per share. This is the value of the shares, the market price or value of the shares. And this is how much the firm will receive if the options were exercised. The number times the exercise price. So this is the value of these shares, and this is how much the firm will receive if the options were exercised. The difference is a loss to the firm, and to whom? To the existing shareholders. Okay? To the existing shareholders. This is the loss because fortunately it is tax deductible. This is the tax saving. We multiply this by the tax rate. So this one is equal to 36.3. This is the tax rate times the loss. So this is the tax benefit or tax saving, okay? The difference, this minus this, is the after-tax loss. This is a contingent liability or a possible loss to the firm or to the existing shareholders in case these options were exercised at that time, okay? If you know the number of shares outstanding, you can calculate the loss per share. The loss per share, in the textbook, the author says that at that time, there were 484 million shares outstanding. So you divide this. If you divide this, so this one is equal to 591 divided by 484 million shares outstanding. So as we can see, this is the loss per share. For whom? For the existing shareholders. This is how much the existing shareholders will lose on their shares if the holders of these options exercise at that time. Make sense? So this is a loss per share. So any questions? Okay. Forget this example. There is something called hidden losses on put options. Forget this example. I will show you the next example is easier to understand. The next example is easier. There is also a hidden loss when the firm issues put options. Put options, they give the holder the right to sell rather than the right to buy. Okay? So if you are a manager of a company or an employee in a company and the company gave you put options, in this case you have the right to sell shares to the firm at a predetermined price. So if the stock price falls below the strike price, for example, the strike price is 20, and now the market price is 10. You can buy it from the market at 10 and sell it to the company at 20. The company is obliged to buy it from you at 20. Make sense? So there is a loss to the firm and the existing shareholders. This loss, again, we calculate the market value of shares to be bought back. At the end of 2002, Dell had 51 million put options outstanding at a strike price of 45. The market price at that time was 25. Imagine, if you were an employee in this company and the company gave you put options, you could have bought the shares for 25 and sold them to the firm for 45. Okay? So the difference is the loss per share because these numbers are on per share basis. If there are, okay, if we know the number of put options, we multiply by the number, and this is the loss, the aggregate loss. If all of these put options were exercised at that time. Note, no tax benefit on put options. This is true in the US and in many countries around the world. Because put options are like luxury incentives, unlike call options. Call options, yes, there is a tax benefit. The loss is tax deductible when we talk about call options. But when we talk about put options, the loss is not tax deductible. Okay? Because many countries around the world, they consider put options as a kind of luxury incentives, unlike call options. Call options are real incentives, but these ones are like too much, something luxury, okay? They are designed to spoil the manager. Okay. The same also applies, or a loss may also apply or arise when other convertible securities are exercised or converted. Of course, the loss is equal to the market value of shares issued minus the book value of the convertible securities surrendered. For example, the company may give you, you may buy, for example, a bond issued by a firm, and the bond is convertible into common shares. Okay? When you decide to convert, the difference between the market price of the shares issued against the bond minus the book value of the bond is the loss to the firm and shareholders. Firms, sometimes they use the market value method. They recognize the loss on conversion, or the book value method, where they records the shares at the book value of the convertible securities with no loss recognized. So there is a hidden loss there. Okay? There is a hidden loss you should search for. Okay. Finally, we have the last part, ratio analysis. For the purpose of the assignment, you do not have to reformulate the statements and do the ratio analysis. Just apply the most popular financial ratios to the reported statements, okay? I will make it easy for you. This is better. Because the financial reports of the company I ask you to value, BHP, the reports are around, the latest financial report, or annual report, sorry, the latest annual report is about 300 pages. I don't want to waste a lot of your time. Just apply the most popular ratios to the reported statements, okay? Should be fine. So the payout ratio, we know what the payout ratio is. It is dividends divided by comprehensive income. Some people, they divide it by just the income reported in the income statement. Total payout is dividends plus share repurchases divided by the comprehensive income. We have dividends to book value ratio. We have total payout to book value ratio. We have the retention ratio. This is the comprehensive income minus dividends divided by comprehensive income, and that is equal to 1 minus the payout ratio. Okay? Note that sometimes for some ratios in the denominator we use the ending book value of equity. Sometimes we use the average. This is true when we talk about payout and retention ratios. For other ratios like the profitability ratios, the most popular one is the return on common equity. Sometimes the return on common equity at time t is equal to comprehensive income at time t divided by common shareholders' equity at time t minus 1. Sometimes we divide by the lagged equity. Sometimes we take the average at time t and t minus 1. We take the sum and divide by 2, or we multiply by half. When to use the average, when to use the lag, it depends. It depends. So remember this point. If during the year there was no addition to equity, we divide by lagged equity. It's okay. But if during the year there was addition to equity during the year, or a reduction in the equity because of share repurchase, it is better to use the average. Okay? Okay? So we use the lag if there was no addition or reduction to equity during the year. We use the lag. Addition when we issue shares. Reduction when we buy back shares, repurchase shares. Okay? So if there was no addition or reduction to equity during the year, it's okay and better to use the lagged equity. If during the year there was addition or reduction to equity, it is better to use the average. Make sense? Okay. There is also the growth ratios like net investment rate and the growth of in the common equity. This one, and this one, and these two are the most popular. These four are the most popular ratios, okay? This is it. I know. A very tough lecture, huh? And we finished just in time, perfect timing.
Yeah, no tax. So calculate the loss without the tax. This is the law. The tax department decided not to recognize the loss. And many other countries also the same. It depends from one country to another. It differs from one country to another. But in America, most countries around the world they do not recognize it. Okay. The first model we discussed is the dividend discount.